Hey everyone, so in this video I want to talk about how the banking system actually creates money and credit, which funds the loans that um, finances firms' purchases of investment goods. So if you just recall, we've thought about or we've discussed how um, households consume only a part of their income, right? So the rest is saved, which is channeled through the financial system eventually to firms who use the proceeds of loans to purchase investment goods. So the key point is that we have this banking system or financial system which funnels the savings of households to firms. So the banking system is going to consist of what we'll call financial intermediaries. So financial intermediaries are the institutions that um, accept funds from savers, which in this case are the households, and makes loans to the borrowers, which are the firms in this case. So before we talk about how the money creation process happens, we need to understand something about the um, financial position of the uh, institutions in the banking sector. So we'll just think about a private bank and um, what the financial position of that private bank looks like. And the way that we measure the financial position, if you will, um, is on something that we call the balance sheet. Okay, so the balance sheet is going to tell us a few things. It's going to tell us about the financial position in terms of the net worth of this bank. It's also going to tell us something about the liquidity of the bank, um, how quickly assets can be converted to cash, or also how quickly liabilities become due. But we're just going to say, simply for our purposes, the balance sheet is going to tell us something about the assets of the bank. That is, what the bank owns, right? So what is owned, or what is due from other institutions, um, and the liabilities, or what is owed to others, right? The liabilities are the obligations of the bank or of any organization, and the assets are um, what what is owned by the organization, what has economic value, if you will. Okay, so we could think about a um, very simplified balance sheet of a private bank. Okay, so usually we present this in this T account where we have assets and assets on the left, liabilities on the right, and we can list what some of those are. But in our very simplified balance sheet of a private bank, we're going to say that on the asset side, we're going to have the loans that are made to firms, and on the liability side, we're going to have the deposits that are made by the households. So households have savings and they deposit it in the bank. The bank uses those deposits to fund loans, which are made to firms. Um, and we could just put some arbitrary numbers on here. We could say that maybe the loans are equal to 90 million, and maybe the deposits are 100 million. Okay? And I make these numbers different for one important reason, and that's that banks are not going to necessarily are not going to be able to lend the entire amount of their deposits. So if households deposit $100 million in the banks, the banks aren't going to be able to make $100 million worth of loans. They can make almost that amount, but they're going to keep some of these deposits as what we'll call our reserves. So the reserves in this case are 10 million. Okay, so these reserves are the funds not lent out or invested by the private bank, but are either kept as vault cash or by deposits at the Federal Reserve, and not lent out. So if we think about the money creation process, we have to think about the lending process. So if we suppose that a firm comes in and comes into a private bank and asks for a loan, we want to think about what's going to happen to the balance sheet when this loan is made, suppose that the loan is actually made. And we want to talk about what's going to happen to this balance sheet. Well, what's going to happen is that this firm is going to promise to pay the bank some amount of money in the future. Let's say that there's a new loan for $10 million. So assets are going to increase by $10 million. So firms now promise to pay the bank $10 million in the future. And how are the firms going to get this money? Now, the bank's not going to just break out a suitcase full of $10 million. They're going to create a deposit with the firm's name on it in the amount of $10 million. So they're going to create deposits. Okay? So the firm's going to expand both sides of the balance sheet to create this loan, and they're creating new deposits. Now, these new deposits are an increase in the money supply, right? So these are like checking deposits. They're an increase in the M1 money supply, and in turn, an increase in the M2 money supply. So this is really the important point, that bank lending creates money. Okay? So what we're going to talk about in the next chapter is how the Federal Reserve, or the central bank of the United States, through monetary policy, can affect how easy it is for private banks to create loans, and how attractive it is for firms to ask banks for those loans. And that's how ultimately we can affect aggregate demand through investment, and how we can have some effect on economic activity in general. So that's where we're going in the next chapter. I hope to see you in future videos.